What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benisaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. Okay, everybody, welcome back to Real Estate Investing Demystified, another great show for you today. We're going to be talking all about data when it comes to real estate.
We're going to talk about, a lot of times we have guests on our show. We talk about their journey and how they got involved in real estate and what really intrigues us. And you can kind of watch our show or listen to our show. You can see a lot of people have come from different sectors, different spaces. There were, academics, there were physicians, there were scientists. And in our case, we have a scientist with us today who's comes from this different space. And the fascinating question is always, what was it about real estate that interested them? I think our space, the real estate private equity space, this idea of raising money from investors and buying real estate and sharing the profits, it's much more intricate than your conventional buy a property and rent it out. So
much more intricate.
It brings in a certain type of sophisticated mind to get involved in this world. So that's my thesis about it. That's my idea. But yeah, let's should we get our show going? Is there anything you want to quickly chat about? Anything happening in the world, or
let's see here. Well, we're in Florida. As everybody knows, we set up our personal life and our headquarters here in Naples, Florida. We're loving it. It's absolutely beautiful. We're headed back to Vancouver, Canada for the month of March. So it'll be nice to get
some skiing in.
Get some skiing in. Yes, you get the sun and then you get the ski. That's on the personal level.
That's on the personal level. We're looking at deals. Deals are still not truly penciling out yet. So we'll get into all that fun stuff on the show as well today, a little bit about market predictions, and we can kind of have a nice dialogue. But go ahead and introduce our guest.
All right, guys. Today we're joined by George Roberts. So George Roberts, he's a data scientist and a bioscientist with over 700 citations in the genomics, microbiology, and physiology. George is also a principal at Roberts Capital Enterprises, which sponsors value-add multifamily opportunities in the Southwest and Midwest. He hosts the Foundery, where leaders are forged daily, a podcast devoted to the role that entrepreneurship, leadership, and mindset play in success in the commercial real estate space. So welcome to the show, George. We're happy to have you here today.
Welcome, George.
Well, thank you. It's a pleasure to be here.
Absolutely. I'm looking forward. I'm going to be a guest on George's podcast.
Cool.
So I'm looking forward to that and in anticipation. But
right on. All right, George, let's get things started off by, please tell us more about your background and how you got your start in real estate, please.
Yeah, sure. So I did come from tech, had a long and happy career there, but realized that it's just much, much more exciting to be the captain of your own ship. I had the opportunity to become a landlord in the depths of the Great Recession. Just didn't make sense to sell a family home. Made a whole lot of sense to move up and buy a new family home. So what to do? So became a landlord, realized that the cash flow was great. Sister came to me in 2016 and said, let's start a construction company. Sounded like fun. So that's what I do. When I find a new adventure, I just jump into it. Maybe without thinking a whole lot, but I think that maybe that describes a lot of entrepreneurs. Sounds exciting. Let's just do it. Yeah. And from there, I realized, well, hey, I want to have my own gig. I know how to be a landlord. So why not just be a landlord at scale? Let's go buy apartments now. So then around 2020, I did my first deal. Now I'm in 6 deals actively, also invest passively, and just love the whole private equity space.
Right on.
Amazing. And did you kind of that switch from being a real estate single family real estate investor and development to multifamily syndication particularly? Did you join a mentorship, a coaching program, mastermind?
No, I just sort of formed my own mastermind with people that I thought were sort of at or above my level. We just got together, discussed, found deals, and it worked. We started with smaller deals. I know a lot of people go in a coaching program, they push you to go for 100 and above, and that's great because your coach, your leader of the program, they can sign on that loan and they can really provide the credibility to do that. But I built it up. maybe a little slower, but it was really, I would say, very much rewarding. And a lot of that money that I might have spent on a coaching program got to go into deals.
Awesome.
Okay, very
Awesome.
cool. It's funny, we always talk about how when we started, if we would have went back, and advice we give to people is getting that mentorship, because it's difficult because there's so many moving parts when you get into real estate, right? You want to kind
Yes.
of like have
Yes.
somebody guide you and lead the way. But
Yes, no, absolutely. Like in retrospect, we would have probably joined a mentorship or a coaching program because you can there's just it's a fast lane in learning really and having a coach. But we learned it the hard way. But that's the best way to learn, right?
yeah.
Blood, sweat, and tears really on the job.
And good for you, George, because you said your money went right into deals, and I'm sure that you also learned doing that as well. So it all worked out. All right, next question, George. What skills were you able to bring to real estate investing from your academic and science background?
I want to tell you, first of all, it wasn't as easy as you might think. I had to figure out how to repurpose myself, and it felt like my last career was so different. I was actually an award-winning data scientist. I had a lot of fun. I was in fintech, and I know you mentioned the outside of the show that this is a field that attracts a lot of people who are really more savvy. And this is where finance and real estate come together in the syndication space. We're buying larger properties. It's a very sophisticated space to be in. But I did spend a lot of time figuring out how to repurpose myself. And I realized that I love talking about data. That's something that hasn't changed. I love teaching. And that's something that I haven't been able to do since I've been in the academic space. So, really, just taking a look at that whole long career that I've had, at first feeling like it's completely different, and then finding ways to make it fun and interesting. Because a lot of people talk about data are boring. And then you also have some places where data is discussed in a very entertaining way, like on cable TV. You can have some real geeky discussions on a podcast like this. I mean that in a good way, geeky. But at the same time, but who's really out there making it fun? So I invented a persona, the data scientist of real estate. I had somebody make a cartoon of me where I go fly around like a superhero. And I really just want to make it exciting. I mean, why can't we have something in the middle, something that's substantive, but still entertaining? So yes, I was eventually able to figure out really how to bring the two together and have a great time doing it.
Great. What is a data scientist? What does a data scientist do?
It's a really broad field. I would say that it's such an exciting field and such a highly paid field. Everybody wants to be a data scientist. So whether you're an engineer and you're handling big data and you're building those pipelines, might be in data science, somebody who's working in AI, someone who builds models, predictive models, statistical models. All of this is data science. Really, to me, at the end of the day, whether you're building a predictive model or whether you're building the data pipeline, it all comes down to telling a story with data. And I think that's what's really missing. I see a lot of people, even experienced people, they'll put out a deal and they'll say, like, hey, 17% IRR, 8% cash on cash, mumbo jumbo. I have no idea whether I believe your 17% IRR at all. I don't want to see that.
It's a
I
prediction
want to see it.
anyways.
Yeah.
It's a 100% a prediction, but yeah, keep going.
100%, and garbage in and garbage out. And exactly, August. And that's the way I look at it is don't tell me what your IRR is predicted to be. Show me a picture of the property. Tell me about the neighborhood. Tell me why you bought it. Actually, let's take a bigger step back. What is a narrative? A narrative brings together all of the important facts, right? I mean, if you tell a history, it's not everything that happened, right? What you do is you leave out all of the unimportant details so that you can see the linear path, even though that may not be how history actually happens. You got to distill it. But people, they just send you straight into the spreadsheet and look at all these numbers and oh, stop it already. Why is the seller selling? Why is this a good deal? Is this a buy and hold? Is this a cash flow play? Are we doing value add? Why does it make sense? How did you come into the deal also? Because I get a lot of people who are kind of new. And it's like, well, I got the best deal in the world. Well, what did you do? Did you just plug in the broker's numbers? Is that why it looks good? Why is this good? I mean, like my first deal, you have to ask yourself, well, how does it come to you? Okay, you're experienced. Okay, I understand how deals come to you. But when you're new, I had to convince myself, well, why, if this is such a good deal, are we having the opportunity? Well, we had some deal fatigue. Two deals fell through, and it was also smaller. All the properties around us had been repositioned, but they were all bigger. They were 100, 200 units, right? And so it made sense to me. The seller is finally ready to deal. because they're sick and tired of being jerked around. And I'm getting a good price because we have a validated business plan. Everybody around us has done it. Obviously, this is an area to buy in, but it made sense to me. 14 units, big for me. I owned a single family home, but it was small to the bigger players. So really, that's what I'm looking for. When somebody comes to me with a deal, give me the narrative. Why does this deal make sense? Then we'll talk about IRR.
Absolutely. And what we say here, great, no, great that you said that. What we say here internally at CPI Capital to others and our team internally is that we're storytellers. As general partners, we're storytellers. It's not just the financials and the economics. It's hey, why are we buying this deal? Where is the competitive advantage? And we're basically storytellers, just as you said.
Absolutely. Why do we love the market? How did we get to these numbers? We kind of dive deep into that as well, so investors can understand it on a high level.
No, tell us something else. With your data science background and using it in real estate, I'm sure, are you using it more into selecting the market you select? Because data science could be helpful in kind of KPIs in a certain market and growth metrics in a certain market to want to invest in, or are you using it on an asset level to kind of concepts of what type of economics the property is producing and what type of cap rates, what type of rent growth is? How are you using this your data science background in the business?
For all of the above. I mean, I chart things, rent growth. I even chart my own health, my blood work. Charting things is amazing because that's where you get to see things. People think like, hey, I'm a data scientist or I have a statistics degree. I'm so smart. Just show me the numbers. Forget about it. Don't look at numbers. Plot it. Visualize your data. I visualize everything, even underwriting, for example. A lot of people kind of say, oh, you data guy, you must be the underwriter. No, actually, I'm the people guy. I would prefer to go on amazing podcasts like yours and reach people and educate people about what I'm doing and let them kind of sift through the numbers and send me things that have already passed the first pass. But I love underwriting and all those other things. But you really hit it in the last segment. It's all about telling the story, and it is about finding the right market. So if you use the numbers, and the first thing people do, they'll send me a deal, and I know they haven't done demographic research because I'll ask, well, hey, what's the demographics of the area? They don't like nothing, crickets. Okay, so let's just do a quick Google search. Like, are we growing here? Are we growing? Are we shrinking? What does the neighborhood look like? You should know the name of the neighborhood. You should know what it feels like to be there at night, even before you go there, right? Go there on Google. Go there on city-data.com. Take a look at each of those census blocks. There's so much you can learn. And that's really where I start out my journey with a property or with a market, is feeling the market. I want to feel what it looks like before I go there. Otherwise, I can't go to 3,000 markets, right? But I can very easily see, dozens or hundreds of markets through the computer. So make sure you just make the most of it. What do you think you're going to see? I mean, is poverty 25%? What do you expect when you get there? Forget that. Cross it off the list.
George, what are your top metrics that you do look for when selecting a market? For example, like CPI Capital here, we're looking for certain growth metrics such as rent growth, population growth, income growth, job growth. We really dive into those numbers first, and then that can really tell us if we're even interested in that market. So yeah, I would love to learn a little bit about your top
diversity
metrics.
Of the market's employers. If they make sure there's no more than 20% employer. There's a lot of different metrics. Like we have our director of acquisitions, Paul Hopkins, has kind of the scorecard for the cities that we look at, and he scored it. Do you guys? I'm sure you and your team do similar things, right?
Absolutely. So a couple of things. First of all, I look at all those things. Everybody's looking at the same thing. And to me, it's really all a matter of pulling into the integrative picture. It's just like you said, August, it's not about, well, what's the employment rate, right? It's, well, what's the diversification among employers? What's the likelihood of employment staying at the same level? To use an example from my favorite investor, Warren Buffett, he likes to look at the quality of earnings, right? It's not just what is a company earning, is it steady and improving? And what's the likelihood of it being so high next year? Like take Houston, for example. There was a time that Houston was completely a cyclical market, 100% driven by the oil industry. Not so much the case now. You got to, I think, really, again, bring everything into a story. And the other thing is remember what's not priced into the market. Knowledge that other people aren't seeking. That's the knowledge that's not priced into the market. So did you find out that there's going to be an airport expansion or something like that? Are you going 3 steps behind the numbers, not just looking at, say, the employment rate or how quickly home prices or rents are increasing, and looking at occupancy and things like that? Are you looking at things like, are you reading articles, particularly for a small town? I like smaller towns because I feel that if you go to a place where there are fewer people looking, it's much easier to dominate the scene. It's much easier to be able to put in a lowball offer and have it accepted. So look for that. Look for that competitive advantage in information.
Got it. Do you use data analytics platforms like CoStar, Yardi
I
Matrix?
do. I love these places. I love CoStar. CoStar is great. And I talk to a lot of investors and say, like, oh, yeah, well, we don't have CoStar. What do you mean you don't have CoStar? Is there a lender involved in this transaction? Talk to your lender. Is there a broker involved in the transaction? Do you have a good rapport with the broker? Can you get a CoStar report from the broker? And if you don't mind, I'd love to dive into CoStar because I think a lot of people get this idea that there's a thing called a CoStar report. There are many types, right? I mean, you can get an underwriting report focused on that address, and that'll give you amazing comps, which, by the way, you want to talk about underwriting. Worst thing in everybody's underwriting that I see, 9 times out of 10, if there's something wrong, it's the comps. Now, people will say, hey, we're going to, get, $300 rent increase. Well, why? Don't show me properties that are much better, right? That's what the OM does. I always say that if you look at the OM, you're going to get 5 comps at least. 3 of them are going to be far better than the subject property, and 2 of them are going to be somewhat better. Throw out the OM. You got to go out and pull your own comps. Right? So yeah, you can get an underwriting report. You can also get a market report, which will help you understand right down to the neighborhood level. Very valuable. So what are you trying to do? What are you trying to accomplish? Don't say like, hey, I don't have CoStar. You have access to CoStar if you have deal flow.
That's right. And another thing good about CoStar, and this kind of leads into our next topic we want to discuss, is what's the market cap in the certain market that you're purchasing in, right?
The cap rate.
The cap rate.
And the predictions for the continued cap rate in that market over the years. Then you can kind of cross-check that with the cap rate you're assuming. So yeah, let's discuss cap rates.
Yes.
I was watching one of your interviews that you've done somewhat recently. You're talking about exit cap, and talk to us about the difference between a market cap, like a neighborhood, a market cap, and a property level cap rate. Or tell us what a cap rate is.
Yeah, if you can first talk about what a cap rate is, and then we can break it down.
Right. So cap rate is a sort of a mystical thing. Okay. What do you really have? Okay. You've got the sale price, and then you got the income that the property produces. And then this is just the number that you use to relate the two. What is it really? Okay. People will give you a mathematical definition, but it's really an idea of what the market sees the risks in the property. So if you have a new investor, they like properties with high cap rate, right? Because you get a high cash on cash, but that's kind of dangerous, right? Those properties wouldn't generate high cash on cash unless the quality of earnings, like I was mentioning earlier, is low. Because what happens if these are people that have, like, say, I don't want to pick on anybody, but kind of the higher you go up the economic chain, it seems like it's a little more difficult to lose your job, or it's a little easier to repurpose your skills. But if you look at people who are more, say, working class, when those people are out, plant shuts down, that can be very, very serious. So that could be one reason why you have a high cap rate. You have people that are paying late, or an older property. I was recently showed a property, it's 19th century. And I said, hey guys, I'm looking this up on Zillow. Is this real? Is this 19th century? Is this really in the 19th century? This has got to be like 1982. Somebody transposed the digits. No. You're going to have different types of problems with an older property. You're going to have a higher cap rate because the likelihood of you discovering something just tremendous. And I had to say, guys, this is interesting, but I have no idea what goes wrong in a building built in the 19th century.
Yeah, okay? I think the confusion is also a lot of newer people in the space is cap rate is also looked at as the cash on cash return that a property produces, right? You talk about risk. You look at it,
Okay.
you look at it from the risk aspect as well. Is like if a property is at a 10 cap, is going to take you 10 years to pay off the property. If it's at a 5 cap, it's
Right.
going to take you 20 years, right? And that's really risk. So the lower the risk the property has, it's going to have the lower the cap rate. Same thing with regions. So lower cap rate regions, have lower risk and a higher chance of appreciation. Like your
If I could just stop you right there,
Sure.
I want to say lower perceived risk because I mean, and I know you know that, but I mean, I think it's always important to just keep that top of mind. It's what the market thinks is the risk.
That's
Yeah.
right.
Yeah.
And what kind of the track record of the market has proven as far as risk? I mean, we're originally based out of Vancouver, and commercial real estate cap rates there are between 2 and 3 caps. So because there's so much weight put on appreciation, last 20 years the market has appreciated 500%. So people invest on that capital preservation, on that hope of appreciation, more speculation. So the cap rates are very compressed. Same thing in your Californias and New Yorks and what have you, Torontos. So now, when it comes to cap rates, let's also talk about the metrics on our underwriting model. So when we are looking at a deal, underwriting a deal, we're making certain assumptions. One of those assumptions is when we sell this property, what cap rate we're going to be selling it at, and that will basically constitute the price we're going to be able to get for the property. Talk to us.
That's good. Can I just piggyback on something you just said? So yeah, it really is the unlevered rate of return. Okay, so I did call it kind of a mystical thing, but and there is some deep reality to what the cap rate is. But again, you just got to understand, and I really want to speak to the beginners in your audience, is that it is the unlevered rate of return. One of the things that impacts the value of real estate or how we value it is the lending environment, right? That's one of the things that makes cap rate good, because you're kind of taking that out of the equation. But you can't take it out of the equation because it determines our returns, it determines the safety of what we're doing. And overnight that changes your returns. So I just feel people are a little too dependent on the cap rate. Now, you mentioned there are many different types of cap rates, right?
Mhm.
Totally true. People talk about the cap rate. What do you mean the cap rate? Are we talking about the seller's cap rate? Are we talking about the cap rate in the OM, which is kind of like the seller's cap rate, only it probably includes about 1 year of work that you are supposed to do but not get paid for?
Or
Are
the
we talking about the cap? Huh?
stabilization cap rate, performer cap rate, exit cap,
Yeah, exactly.
cap rate.
We could talk about cap rate all day, and they're all different. Is it the cap rate you're buying at? Is it the cap rate you're going to operate at after you have a refinance? At what rate? That's in the future. We don't know. Is it the cap rate that you expect to sell at? And I think what you're hinting at is that a lot of these, operators, what they're going to do is they're going to say, hey, we're going to get into this cap rate and we're going to get out at the same cap rate or maybe a quarter above it. Like, that's dangerous. Because again, if you take that NOI divided by the cap rate and you say that's what this place is worth, a lot of things can happen in 1, 2, 3, 5 years. Lending environment can change. Perceptions of commercial real estate could change. Neighborhoods get better. They also get worse. And if you don't put in the work and turn it into a C plus or a B minus, like you said you were going to do, if you don't execute, then you're not going to get there.
Hyper supply in certain neighborhoods that will,
Yeah.
bring competition for your property. So yeah, a lot of those things. Fascinating stuff. All right, let's move on. And
Fascinating and confusing stuff, I'd say, for a lot of people with the cap rate. You know what
Yes.
I mean?
Exactly. If you're not a little confused, I mean, there's layers and layers of complexity to this. It's not just like the stuff the gurus slap on a blackboard and say, "Hey, this is it. Now you can value commercial real estate."
yeah. Yes.
Exactly.
All right. Okay. So let's talk about macroeconomics. I was watching your presentation with our good friend Stefan Svetkov, and you were talking about recessions over the past 100 years or so, and I take it that you're in the belief that real estate is cyclical. We actually had a guest on our show who didn't believe real estate was cyclical, but who was an expert. But I'm guessing is that you believe that real estate goes in these cycles? Is it fair
Sure,
to
real estate goes in cycles, and it's not acyclical, it's just less cyclical than the stock market. It's not as liquid. I mean, hey, you got to get money out. Where are you going to take it first? You're not going to go to a broker, put it on the market, sell it at probably a bad time. No, you're going to liquidate the stocks, right? So I think that's it's an advantage and a disadvantage. On the one hand, if you should have your money in different places. I'm a huge fan of diversification. You don't have all your money in real estate or all in the stock market, and you need some in cash too, maybe precious metals. I'm not going to tell people what to do with your money. I'm just going to say don't put it all in one place, and then take advantage of those cycles. We're in a really weird part of the cycle. I mean, where are we in the cycle? I mean, we're waiting for this recession, and it's like the sword of Damocles. I mean, we've been waiting since what? Since the Great Recession. And how many years is that now? Are we talking like 16 years or,
But George,
from the start of that?
but now we've had 3 quarters now that the GDP has been negative GDP growth, and the yield curve has inverted. So your 10-year Treasury relative to the 2-year Treasury is inverted. So people rather take a 10-year Treasury over a 2-year Treasury. So that yield curve has inverted. So that's kind of a telltale sign that we're currently in a recession. But the officials are saying we're not in a recession because the job markets are strong and we don't have large amounts of unemployment. So that's why they're not really calling it a recession yet. And that's, when Jerome Powell was saying he's going to need 1 million, unemployment, million in job loss. People are like, hey, I thought your job was supposed to be to create jobs, but their job is more price.
Where's the dual mandate when you need it?
Exactly. The job is more price stability. So I would say I'm happy, excited to hear your input on this. But I believe we're currently in a recession cycle. And my belief is that real estate goes through this cyclical cycle, but it goes on a incline line. Real estate continuously goes up because of you have inflation, so the value of money reduces over years, and it makes it more difficult for people to own properties, and the price of property goes up over the years. But it goes through these cycles: recession, recovery, expansion, hyper supply. And I believe currently we're in the recession phase, kind of coming out of the recession phase of the cycle, or somewhere there. And some scholars that I've been listening to and reading the literature recently say that real estate cycles go in like in a 20-year, approximately 18.6-year cycle. So they're saying that we're currently in the recession phase of the cycle, which is basically no, actually, they're saying that we are near you haven't even gone into recession. They're saying that we're going to hit recession in 2026. I believe we're already in recession, particularly in multifamily. Single family is a bit different. Mm-hmm. Where would you say we're today when it comes to kind of those? And if you could visualize it as a clock, where 12 o'clock is the top of the market and 6 o'clock is the bottom of the market, where are we today when it comes to at least multifamily?
Yeah, it's a great question. I love the visual too. That's a beautiful metaphor. I'm going to say maybe about 8 o'clock, because I think we're going to have another upswing. Okay. I want to come back to that recession because the general economy is very important. But you just mentioned the oversupply and expansion, oversupply, et cetera. This is a huge story, right? I mean, we are hugely undersupplied in the United States in terms of housing units. So if we're going to talk about multifamily, oh my goodness, it's going to take us years and years to catch up. I mean, we are maybe 5+ million units behind where we would have been if we would have just continued to build, say, 1.5 million each year since the Great Recession. And right now, I mean, we just had a month where we were above 1.5 million, but our leading indicators are below 1.5 million. And I'm talking about, of course, the housing permits and starts. So we're not going to sustain that. I mean, we're not even replacing what we need. We have a lot of immigration too. That's another thing to take a look at. If you look at the official statistics, we've never had less, or we haven't had less for many, many years. But we all know that we probably have more. So we probably have even greater housing needs than we've had in recent years. This is a true crisis. I think this is the only thing that's really holding the cart together, because we have interest rates going up like crazy. Try to finance something these days. Not only do you have the issue of the interest rate, but these lenders, they're all skittish. and they'll pull the rug out at the last second, or if you're lucky enough to get the thing to go through, you never know how the numbers might get changed around at last instant. I mean, lenders are really, really nervous. So what's holding it together is the fact that people need a place to stay, and we just can't build it. So that's why I'm going to say that I think we are going to recover. I think interest rates are coming down. That's why I do say the cap rate is a little bit mystical. Yes, it has a mathematical definition, but it ignores certain other things. I mean, it's very unstable because it can change on a dime as soon as investors' impressions change, or as soon as the lending landscape changes. So I think that we do have a good ways to go. But again, we're only being saved because builders got knocked flat on their back in that last recession.
Okay, George, awesome. Let's kind of just change. I want to start kind of focus on the LP investing because you've invested as an LP and a GP. What advice do you have for LPs who are presented a deal, right? But they don't have the financial expertise to even comprehend the underwriting of the deal, right? I mean, it's so many numbers, it's so comprehensive.
Even ask for it. In some cases,
even
LPs don't
Yes.
even know to ask a general partner, hey, can I see your underwriting model? You have a team that you just told us about that helps you with your underwriting and analysis.
That's right. But for LPs, they don't really even understand that, just even changing the exit cap or the rent growth can substantially change the return. So that's why I'm saying that, we get lots of syndicators and they put these numbers in the underwriting and it, makes it look like there's these 20% average annualized returns in the economic environment that we're in right now. But really, it's only 15.
Even on some deals that we look at, other people end up taking those deals and we're like, hey, when we plug in the purchase price that they purchase the property at into our model, we're getting single digit returns
like
for our
8%,
LPs.
and they're advertising 20%. So we're thinking, okay, we got to start educating LPs a little bit here to ask for, hey, what's the exit cap? What's the rent growth that you guys have used? And really try to dive into seeing if they were actually conservative. Because a lot of GPs throw out that word too. Oh, we've been very conservative in our underwriting, and it builds a lot of trust with LPs. But again, guys, a lot of LPs are doctors, lawyers, accountants. They're not real estate people.
They're
So
not
they don't
underwriting
even,
and they're not
That's right.
analysts. But also this idea of syndication investing in syndications and funds is 100% passive, or this passive option is not really passive. The due diligence
That's
you do
right.
on the GP, the due diligence you do on the deal, the questions you ask, to have somewhat of a friend or advisors you can reach out to about the deal is that work you have to put in, and it's not really 100% passive
That's
option.
right. And on my calls with investors, as I'm really focused on the equity side of the business, I do tell investors, hey, listen, these are really some important things that you got to look out for. And I always tell them, try to find 3 great GPs to work with, but these are also some things that you got to look out for.
We haven't done a deal in 19 months.
Yeah.
I mean, in retrospect,
Proudly haven't done a deal in 19 months.
I like that. Good.
But George, let's get back to the question. Like, what advice do you give LPs, when it comes to when they get
Okay, yeah. So Ava, I think you hit on it. You said that, hey, it isn't really easy. It isn't really passive, right? Passive investing is a lie. This is hard work. I mean, even if you're investing in the stock market, you need to read the financial statements. That's something most people don't do, right? Warren Buffett will tell you, you don't read the financial statements, don't invest in individual equities. Well, same thing here. You got to start educating yourself now. You can say like, well, maybe I'm not ready to invest. Well, people do the same thing like shadow investing, right? What would you do if you had invested in that stock on that day and you only had X dollars and you assume that you sold? Just look at deals. Start looking at deals. And it was also mentioned a moment ago, we're going to have to ask for the underwriting. Yeah, ask and you shall receive, right? Knock and the door shall be open to you. I love this because it's not only is it true, but it's so much the truer the more you practice it. Always ask for the underwriting. There's no reason why you should ever be denied looking at the original underwriting. And when you get to the so-called underwriting,
sometimes that's a red flag right there. When the GP is not
Yes.
being opaque and is not giving you certain information, that's enough to know that this is not somebody you want to be married to for 5 or 10 years.
100%. Yeah. So I want to get to that in a minute. There's at least 3 things you got to look at. You got to look at the operators. You got to look at the deal. You need to understand the market, but really you got to understand yourself, right? I mean, that's really like the missing piece. Whatever you invest in, your disposition has to match it. A lot of people look at investing as an intellectual pursuit, and it is. But what's really most important here is that if you're not a patient person, syndication is going to drive you nuts. Your money's going to be locked up for years. And if you're not comfortable with twists and turns, investing in like new construction or something like a conversion, the more value add you're doing, and the more that you're repurposing, redeveloping a property, that's going to drive you nuts. So just make sure that your investment really makes sense to you. Is this something you really want to be committed to? But anyway, yeah, to get back to the numbers, I mean, just start. There's never a better time than the present to start. So look at deals, uh, go look through the underwriting.
Ask the
And
right
then again,
question.
like you mentioned, it's like a marriage, right? Test it out. If you start asking for things and you're getting stonewalled, forget about it. And if you're not comfortable with the response you're getting or who you're talking to, right? Like if you deal with some of the gurus that have a lot of units, this is wonderful, but you're going to have an investor relations team you're dealing with. Okay, I have 6 active deals. If you call up investor relations at Roberts Capital, you're going to get me. So there are advantages to both, but make sure you're comfortable with that. Are you comfortable talking to someone who talks to the person in charge? Or do you say, well, I need that track record. I'm not going to invest with somebody who has less than 5,000 units. But again, yeah, you really got to understand yourself. I don't hear people talking enough about that. I hear everybody talk about the team, bet on the jockey, not the horse. But yeah, but you, you're along for the ride.
Yeah.
That's right.
No, great.
That's
All right.
right.
Thank you for all the wisdom and transparency. Let's kind of get to a few questions. Kind of,
Sure.
they're not really rapid fire, but kind of somewhat quick questions before we get to our next segment of our show. Let's talk about predictions. Where are the interest rates going, George?
Well, I'll tell you something. I'm a man who has made predictions for a living as a data scientist, and I don't really like to make predictions, though. It's kind of a
This
bit
is being recorded.
ironic.
This is being recorded. It's on the record. So,
It is on the record. But I've heard it said that intelligent people make conditional predictions. So what I'm going to say is that I think interest rates are going down. It makes sense given that inflation is going down. But again, to make conditional predictions is that we don't know where inflation is going. Keep an eye on that. Keep an eye on where inflation is really at. Just as you mentioned, hey, we got these jobs reports that show, hey, things are good. We can't call a recession. Well, how much do you trust the job report? Okay. And when the official statistics tell us the inflation is at such and such a point, do you really believe that? Because if we have a second run of inflation like we had in the 1970s, I got news for you. Those interest rates are going straight back up. So yes, I think we're headed down, but watch out and we don't get too cocky. First thing I learned about making predictions is that you don't simply trust your own predictions. You need to think about all the ways you're going to pivot if that prediction turns out false.
fair enough. So by summer 2024, currently the Fed's fund rate is at 5.25 to 5.5. Where are we going to be at approximately?
Okay, how about this? Can I answer with a question? How many times has the dot plot changed? So we could say that I think the last time they said they were going to have three drops over that time frame, right? Like 75 basis points or so. Is that if you want to have any idea what's going on, don't look at those dot plots. Ask yourself how that dot plot of 2026 has changed 3 or 4 or 5 times practically every quarter. So
Mm,
yeah, certainly I think we're going to be down maybe 1%. But what I would say is rather than trying to, nail it and say that I think I know where interest rates are going to be, I just look for nice step downs these days. I just got an agency loan and I paid, maybe 80 basis points to get 32111 step down. That's worth it because I don't want the yield maintenance. And I just don't want to be stuck in a situation where I can't get out of it. So I would say just expect that rates are probably going down, but just be ready to pivot.
got it. Got it.
Awesome.
You want to go ahead and ask
Yeah.
that, Ava?
George, what are your top states to invest in? What's the top
Okay,
state?
great. Well, certainly I like the best states to invest in, which I think in maybe, Tennessee, Kentucky are great. I like Ohio, certain parts of it. I just really like that middle band of the latitudes. I love it. And if I'm in the state already, that's bonus. I've got a deal in Tennessee and 2 in Kentucky. I've got a couple in Kansas City. I just love, love, love those states. I think these are great markets and they're not overdone. You don't want something that's overheated. We talked a lot about demographics. Take a look at the volatility of a market. I don't want to go to these markets like Miami, Las Vegas, Boise, Idaho. These are some crazy places, things that have just really gotten way ahead of themselves. The Midwest is a lot calmer, but you know what? It might be fair to just kind of lay back. Like you said, you proudly haven't done a deal for 19 months. That's the sort of attitude you want to have right now. But if you are doing deals, do it where things are stable. And I really like the Midwest. I like Kansas City. I like Cincinnati, Indianapolis, Louisville. These are some places I like. And I particularly like East Tennessee because it's growing. It's not like West Tennessee, which has some problems. It's losing some population. It's not like Central Tennessee that I think is just way too hot to touch. But yeah, there are certain parts. But again, I like to go where there are fewer players on the field.
Nice. Where are you based out of, George?
I'm based out of Michigan, which is another reason why I like Ohio. I'm in Ohio. I feel like half the weekends of the summer because that's where I sail my boat out of. Sailing's a big part of my life.
Wow.
And down I-75, I could get to Knoxville in about 8 hours, at least theoretically, if I don't have the kids in the car.
Okay, very cool. Very cool.
Cool. Great. All
So
right.
yeah, that I-75 makes a lot of sense to me. Okay. I can just jump right on that and I can be to a lot of really nice destinations that are strong that I can still potentially get out there and see without a whole lot of trouble. But again, yeah, a place like Cincinnati, somewhere I can get to in 4 or 5 hours is a lot easier.
Nice. That's why he appreciates our sailboat in the back because he
Yes, I do. I greatly appreciate that. That's beautiful. Yeah, you got a cutter out there. You got 2 jib sails. It's beautiful. There's nothing like a great old wooden boat. And you were remarking about how sailing is something people think about when they get rich. But I believe that really the game is about wherever you're at economically. You got to live life now. So I bought myself a $5,000 sailboat even before I went hugely into real estate. I've still got it. I put another 5 into it. I'm not going to tell you that it's a cheap hobby, but you don't have to wait until you can buy the yacht. Just go out there. It's a beautiful thing. It's 25 feet. I can single hand it.
Nice.
Yeah. Yeah. Don't be the person who accumulates a giant pile of poker chips and then says, now what do I do with my life? I don't feel a sense of purpose. Go out and live it now. And then you got to ask yourself, hey, how do I feel when I, take the foot off the gas or downshift a little bit?
We're gonna get into all to philosophical stuff right here, George. So Ava, go ahead.
Yeah, thank you for all of that, George. But now we're gonna head to our next segment of our show, the 10 championship rounds to financial freedom. So I'm gonna ask you a series of questions, whatever comes top of mind. Are you ready?
All right, let's do it.
Okay, here we go. First question, George, who's been the most influential person in your life?
I'm just going to start with investing. Benjamin Graham, he was the founder of value investing, and 100%. I think that all investing at some level is value investing. Otherwise, you're speculating. Benjamin Graham.
Okay, right on. All right, George, what's the number one book you'd recommend?
Oh, how about Dale Carnegie, How to Win Friends and Influence People? It's great for communication. It's great for business. It's great for your personal life. Realize that taking an interest in people makes people more interesting.
Give us one more.
Okay, one of the first.
It doesn't have to be investing or economics, but it can be any book.
Yeah, Stephen Covey, 7 Habits. Sharpen the saw. Always sharpen the saw. You have to put some time on your calendar, and I do it every day. First 3 hours of the day, I should just be writing my book. Okay, I make sure that at the end of the day, every day that I get some time to exercise, and I even have put time to appreciate literature. You got to work on your mind. Okay, exercise the body, exercise your mind, sharpen the saw. I love that book, 7 Habits, beautiful thing.
Can we have one more?
Okay, here's another one. It's a little bit philosophical, but it's Think and Grow Rich. I love it because it's a book about wealth, but how does it start? Gives you 12 things that are more important than wealth, like your friends, your relationships, integrity. All these things are more important than wealth. So I'm thinking, so why am I continuing to read this book about wealth? Well, you have to have a field to operate in. So that's what I'm doing. I operate in the field of wealth, but I have that same philosophy that it's not about the wealth. That's just what we're doing with our time.
Nice.
Thank you for that.
It's how you do it.
How you do it. Okay, George, great. Next question. If you had the opportunity to travel back in time, what advice would you give your younger self?
So it's just don't worry, be happy. It's going to be all right. So I always worried about everything. I was huge in academics, PhD, so many years. Somebody told me once, hey, this test is not going to change your life, right? Thought about this, so true. So I stopped worrying about things. If I could know how well things were going to turn out, I would have worried half as much, and I might have done 50% more. Don't worry, it's going to be okay. Don't focus on the scoreboard, focus on how you're training.
Nice. Love that. All right, next question. What's the best investment you've ever made?
Oh, wow. Other than in myself? Okay, that's a throwaway answer.
Oh, that's great. A lot of people, a lot of people say that, but keep going, keep going.
Okay, good. No, but that was, I had to say it, but that is a throwaway answer because, best investment. Okay, fine. I'll tell you what, it's my health. Okay. It's taken me literally 50 years to figure out my health. I've been in great shape multiple times in my life, but to finally figure out my weight, never overweight, but to figure out what it took. And for me, it's just exercising throughout the day.
You look
I
great,
will.
man. You look great. You got to tell us some of your secrets, man.
Yeah, yeah. I could go in the back. I can show you what I'm actually eating. Like I'm. The next book I want to write will be the chocolate diet because I know that you can eat chocolate because you're eating sugar. You already have fruit in your diet. Pair it with some chocolate. Just pour that chocolate on there. No sugar added.
Yeah, wow.
And I'm telling you, you can find creative ways. Yeah. So I just exercise throughout the day. Yeah. Yesterday I did 730-pound dumbbell presses. A few days before that, I did 600 dips. So can I do that with a regular job? No. I get down there at 8 a.m., 10, noon. So figure out that health. That was the best thing. It's changed my life.
Good for you. Good for I eat dark chocolate every day. Just saying. Yes. All right. Okay. Next question, George. What's the worst investment you've ever made?
And what lessons did you learn from it?
Oh, sorry. And what lessons did you learn from it?
Yeah, perfect. Anytime you're doing something new, there's danger. Realize that danger. And it's okay. If you don't have other people's money in it and you're doing something different, invest in a Class D property. I want to say it took about 14 months to turn it around. Had two really bad property managers. Just literally a third one could have sunk us. But you got to understand that when you do something new, it's dangerous. Don't put someone else's money into it, which we didn't. And just understand the pain because it's not just money, right? I mean, we're probably going to make a decent chunk of change on that. But how much brain damage do you have to go through to get there? And when you have two bad property managers and you got to fire them, threaten legal to get them out of your life, that's brain damage. You don't want to suffer that. So what do you learn when you try something new and you don't like it is stick to investment grade properties.
Perfect. Okay, George, how much would you need in the bank to retire today? What's your number?
Gosh. See, I want to tell you, Ava, that's why I went into the philosophy earlier. I don't have a number. I mean, I could say like, well, I want at least 10,000 coming out each month. And so I better calculate, based on, think of it like a cap rate, I better have this much. Well, it's going to change, right? But even if I say I could come up with that, you know what? I found that the more freedom I have in my life, the more my imagination grows. And that's why I insist you got to live today. Every day I dance tango. I got my mate gourd here. This is what they drink in Argentina. I have my Spanish teacher. I call her direct to Buenos Aires every week, 3 hours. So that's what it looks like for me to take the foot off the gas a little bit. Do I still feel like I'm contributing to society? And what does that look like? But if I took the foot off the gas a little more, I'd need 10 times more. So I don't have a number. My answer is live like you can today. And then, grow. You're going to build it up. It's not stop and go. It's building it up.
Nice.
Perfect. Okay. If you could have dinner with someone dead or alive, who would it be?
I say Warren Buffett, not just because people actually pay $1 million to have lunch with Warren Buffett. He's famous for saying that value is what you get, price is what you pay. But I would say there's got to be a lot of value in that. He's amazing, interesting. I just love all his wisdom. Really respect his career. Respect how the man has grown. Look at his interviews from the 1960s to 1980s. I remember there was that bank takeover to today. I mean, the man has grown personally. To talk to somebody like that, who's had such a long career and who never stopped growing, that would be the best.
Amazing. Okay, George, if you weren't doing what you're doing today, what would you be doing now?
Oh gosh. I really loved my data science career, and I actually kind of went back to it. Can't talk about details, but I actually started freelancing because it's just fun to solve scientific problems and to help computers do that. So I don't know, but I could be happy solving technical problems.
Perfect.
Nice.
Okay. Book smarts or street smarts?
Well, street smarts always, because you can get the book smarts later. But if you have the street smarts, if your head's on straight and you have the right values, you're going to learn what you need to know. So yeah, book smarts important, but street smarts 100%.
Nice.
Perfect. Okay, last question, George. Okay, if you had $1 million in cash and you had to make one investment today, what would it be?
Would be a yacht.
Gosh, I love Kansas City. I love KC. I love apartments, and I do love the multifamily market. It's really, really hard right now, but if I had to go all into one thing, gotta love the market and still love multifamily when it's chosen properly.
Nice. Awesome.
Nice answer.
Great.
Okay, George,
Amazing.
thank you so much for bringing so much value to
Absolutely.
all of our listeners that are listening in. And
You
last,
can edit that down to a speed round. Sorry, wordy answers.
Perfect. Just quickly let everybody know, what's the best way that they can reach you?
Okay, sure. George at robertscapitalenterprises.com. Send me an email. I'm on LinkedIn all the time. Or if you just want to learn about me, go out to YouTube, Data Scientist of Real Estate. I'd love to talk.
Amazing.
Wonderful.
Thank you so much. Really
Thanks,
appreciate
George.
you coming here.
My pleasure. Thank you so much.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.